All right, guys. So this video covers other types of investments, and it starts off with municipal fund securities. You want to remember these are state-sponsored, tax-advantaged savings vehicles regulated by the MSRB, Municipal Securities Rulemaking Board. So you want to remember anything municipal is state government, state and local government, or municipalities. So anything that comes from any securities that come from your state and local government are municipal fund securities. First type of municipal fund security you have are Section 529 plans. A Section 529 plan is a specific type of education savings account available to investors. The plan allows saved money to be used for qualified expenses for K through 12 and post-secondary college education. Qualified expenses include tuition at an elementary or secondary public, private, or religious school for up to $10,000 per year. Because these plans are state-sponsored, they are defined as a municipal fund securities. Now, there are two basic types of 529 plans. You have prepaid tuition plans for state residents. Prepaid tuition plans are for state residents. And then savings plans are for state residents and non-residents. When it comes to prepaid plans allow residents to lock in current tuition rates by paying now for future education costs. This is a hedge against tuition inflation. But outside of prepaid tuition plans, the more popular option is the savings plan. So not prepaid, just a savings plan, which allows donors to save money in a separate account to be used later for education expenses. When it comes to a few characteristics of the two types of 529 plans and what they have in common, overall, maximum contribution levels can vary from state to state. So that is a commonality. Contribution levels can vary from state to state. There is no annual maximum contribution. Gift transfer taxes apply to donations, but the law allows a donor to forward gifts up to 5 years. Funds may be used for qualified education expenses for both K through 12 and post-secondary college costs. Withdrawals are tax-free if used for qualified purposes. You want to remember funds grow tax-free. There are no income limitations on making contributions to a 529 plan. Account balances left unused may be transferred to a new beneficiary that is related to the original beneficiary. So let's say you have this plan for one child saving up money for their college education and they end up not going to college. Well, those funds that were accumulated can be transferred over to a new beneficiary who is going to college if they are related to the original beneficiary. When it comes to rollovers are permitted from one state's plan to another state's plan, but not more often than once every 12 months. Another name for 529 plans could be qualified tuition program. And then you have local government investment pools. States establish local government investment pools to provide other government entities, such as cities, counties, school districts, or other state agencies, with a short-term investment vehicle. A local government investment pool is generally formed as a trust in which municipalities can purchase shares or units in the local government investment pool's portfolio. Some key points to know about LGIP. While not a money market fund, most local government investment pools operate similar to one. An LGIP may be permitted to maintain a fixed dollar net asset value. Maintaining a stable net asset value similar to a money market mutual fund facilitates liquidity and minimum price volatility. LGIPs are not required to register with the SEC and are not subject to the SEC's regulatory requirements. LGIPs are sponsored by a state and considered a municipal security. Investment guidelines and oversight of LGIPs can vary from state to state. So anything that's covered under local government, state's jurisdiction, you just want to think federal government, such as the SEC, usually stays out the way, usually don't get involved. So, with no SEC registration required, there is no prospectus with LGIPs. There is no prospectus. LGIP programs do have disclosure documents, which generally include information statements, an investment policy, and operating procedures. The information statement typically details the management fees associated with the LGIP. So once again, who are the investors in LGIPs? You want to remember the investors in LGIPs are other government entities, not retail investors, but other government entities. Another type of investment you have are able accounts. Able accounts means achieving a better life experience, ABLE. Able accounts are tax-advantaged savings accounts for individuals with disabilities and their families. They were created by the ABLE Act of 2014. The beneficiary of the account is the account owner, and income earned by the account is not taxed. So ABLE accounts are savings accounts, once again, for individuals with disabilities and their families. What are the rules for ABLE accounts? ABLE accounts are available to individuals with significant disabilities. Only one ABLE account per person is allowed. The account owner is the beneficiary. Contributions to these accounts can be made by any person, including the account beneficiary, as well as a family and friends, and are made with using after-tax dollars. Some states allow income tax deductions for contributions made into an ABLE account. ABLE accounts have an annual maximum contribution, which may change annually to account for inflation. Growth in Enable account is tax deferred, and withdrawals from Enable account are tax free. Next, we're talking about partnerships and direct participation programs. A partnership is a type of business organization in which the partners manage the business and pay taxes on the business's profits, if any, in relation to the size of a partner's ownership. There are two types of business partnerships. You have general partnerships and limited partnerships. On the exam, you will see questions about limited partnerships because interest in a limited partnership is a type of security. But here are some points to remember about a general partnership. When it comes to general partners, all the partners are general partners. When it comes to general partners, all the partners have some level of management authority. Ownership may be unequal, and general partners have no liability protection. Just think general partners bear the full risk of owning a business and all that comes with owning a business. General partners bear full risk, no liability protection. Here are some points to remember about limited partnerships. A limited partner has one or more general partners and one or more limited partners. General partners manage the business and have no liability protection, whereas limited partners have no management responsibilities and are protected from the liabilities of the partnership. So think risk is limited with limited partners, no management responsibilities, and are protected from liabilities. If a limited partner participates in the management of the business, they may lose their liability protection. Income received from the limited partners by limited partners is called passive income. Limited partners may be sold through private placements or public offerings. If sold privately, investors receive a private placement memorandum for disclosure. If a public offering, limited partners are sold by a prospectus. If it's public instead of private, they are sold by a prospectus. Because always remember, public requires prospectus. Public requires prospectus. Generally, limited partners are liquidated on a predetermined date specified in the partnership agreement. So, why are limited partners formed? Limited partnerships are formed to invest in a specified type of business. So a few more points to remember about limited partnerships. You want to remember the most common industries with limited partnerships are real estate, energy, such as oil and gas programs, and equipment leasing are the most common examples of limited partnerships. These programs often experience losses in the early part of the program. These losses pass through to the investors It may be used to offset sources of passive income from other programs. And then when it comes to direct participation programs use depreciation and depletion to reduce taxable income. These deductions are not actual cash costs. Rather, they reduce taxable income without affecting cash flow. What are the benefits of limited partnerships? Limited partnerships have an advantage of an investment managed by others. So the investment is managed by general partners. So limited partnerships don't have to worry about management. Limited partners have limited liability. And limited partnerships have a flow through of income and certain expenses. So what would be some risks of limited partnerships? In addition to business risks, they also have liquidity risk. And the main risk you want to remember is business risk and liquidity risks with limited partnerships. Any transfer of interest in a limited partnership requires permission of the general partners. An investor in a limited partnership should assume she will own the program until it ends. Limited partnerships are highly illiquid, meaning very hard to sell. So always connect illiquid, meaning very hard to sell, to limited partnerships. Limited partnerships are illiquid. So now here we're breaking down real estate investment trusts, exchange traded funds, and exchange traded notes. When it comes to real estate investment trusts, a real estate investment trust is a company that manages a portfolio of real estate, mortgages, or both to earn profits for shareholders. Real estate investment trusts pool capital in a manner like that of an investment company, but are not investment companies, neither open nor closed. Shareholders receive dividends from investment income or capital gains distributions. When it comes to real estate investment trusts normally own commercial property, own mortgages on commercial property, or do both, known as a hybrid. They normally are organized as trusts in which investors buy shares or certificates either on stock exchanges or in the over-the-counter OTC market. Real estate investment trusts normally fall under the conduit tax theory, subchapter M, meaning that they are taxed the same way as a mutual fund and can avoid triple taxation. Remember, real estate investment trusts can avoid triple taxation. Now, many real estate investment trusts are registered with the SEC and therefore are subject to all disclosure requirements. These are known as public REITs, real estate investment trusts. However, there are REITs that are not registered with the SEC, known as private real estate investment trusts. Non-registered real estate investment trusts are not subject to the same disclosure requirements as a public real estate investment trust and are subject to greater risk. And then you have exchange traded funds. Now, exchange traded funds, considered an equity security, invests in a specific group of stocks and generally does so to mimic a particular index, such as the S&P 500. In this way, an ETF is similar to a mutual fund that tracks an index. The difference is that exchange traded funds trades like a stock on the floor of an exchange, and in how it trades is like a closed-end investment company rather than an open-end mutual fund. ETFs are registered as either an open-end or as a unit investment trust, but is different in many ways. Some points to remember about ETFs. Because they trade in the secondary market, an investor can take advantage of intraday, meaning within one day, price changes. So ETFs can take advantage of price changes within a day. If you ever see intraday, that's what that means. ETFs can be purchased on margin with borrowed money and sold short. Expenses of ETFs tend to be lower than those of mutual funds. So exchange traded funds have lower expenses than those of mutual funds. And the management fee is also low with ETFs. Like an index fund, most ETFs do not actively trade within the fund. This generally results in greater tax efficiency for the investor, since the index fund realizes less taxable capital gains. So there's less taxable capital gains with ETFs. Every time a person purchases or sells shares, there is a commission, and those charges can add up over time. So a few advantages of ETFs is that they have pricing and ease of trading. Because individual ETFs are traded on exchanges, they can be bought or sold anytime during the trading day at a price they are currently trading at, as opposed to mutual funds, which uses forward pricing and are generally priced once at the end of the trading day. So pricing and ease of trading is an advantage of ETFs. Another advantage of ETFs is margin. ETFs can be bought and sold short on margin, so they can be bought with borrowed money, you can think. Another advantage is operating costs. ETFs traditionally have operating costs and expenses, like I said, lower than most mutual funds. Tax efficiency is an advantage of ETFs. So what are some disadvantages of exchange traded funds? A disadvantage is commissions. The purchase or sale of ETFs shares is a commissionable transaction. The commissions paid can erode the low expense advantage of ETFs. Another disadvantage of ETFs is market influences on price. So because ETFs trade on exchanges, share prices can be influenced by market forces such as supply and demand. So influences on price is a disadvantage of ETFs. because it just flows with a particular index, which can go up and down. Last that you see on here is exchange traded notes. Exchange traded notes are unsecured debt securities issued by a bank or financial institution. Therefore, they are only backed by the good faith and credit of the issuer. So not backed by any assets, only backed by good faith and credit of the one issuing. Exchange traded notes are bond-like instruments with a stated maturity date, but they do not pay interest like a bond, and they offer no principal protection. Instead, exchange traded notes investors receive a cash payment linked to the performance of the underlying index, minus management fees when the notes mature. Because the returns of exchange traded notes are linked to the performance of a market index or basket of securities, investors are also exposed to market risk. Though these are called exchange traded notes, very few of these trade in the secondary markets. And you want to remember, exchange traded notes, like limited partnerships, these investments can be illiquid, hard to sell. And here's a guide for these investment types.